You're about to get an expert guide on your business credit scores. Look, if you're looking to get the most money for your business at the best terms, then you have to understand your business credit scores. Your business credit scores are the main tool that lenders and credit issuers are using to determine if you should be approved for credit financing, how much you should get, and the interest rates you should pay. So if you want to get the most money at the best terms, it all boils down to your business credit score quality, and I'm about to show you how to get that right now. All right, so let's start from the top. What is a business credit score? Well, business credit scores are provided by the business credit reporting agencies, and they're literally used to depict your likelihood of defaulting on credit and financing that these lenders and credit issuers issue you. So it actually, by definition, determines your likelihood of defaulting, which means 90 days late. So it predicts your likelihood that you will go 90 days late on credit and financing that's issued to you. And lenders and credit issuers really use these business credit scores to determine three main things. Should you be approved, how much money should you get, and the rates and terms you'll pay. The lower your risk, the more likely it is that you'll get approved for credit financing, you'll get higher approval amounts, and you'll also get that financing at better terms. Now you know the basics of how lenders and credit issuers use business credit scores. Let's talk about some other uses as well. Look, a lot of different companies and individuals are looking at your business credit scores. First of all, they're also used by insurance companies. So insurance companies use this to determine the type of insurance you may be able to qualify for and the rates and terms that you'll pay on that insurance. It's also even used by your utility companies to determine the exact same thing. Even your prospects, clients, potential buyers of your company, potential investors are all looking at these business credit scores to gauge, well, your credibility, your lendability, how credible and reliable you are. So because your business credit scores are public, you've really got to make sure that you control these scores and that they're exceptional because it is your overall company's reputation. Speaking of which, how do you control these scores? Now that you're starting to get a feel for how important your corporate credit scores are, how do you actually control them? Well, there's actually 5 main credit scores offered by each of the 3 main business credit reporting agencies, Dun & Bradstreet, Equifax, and Experian. Don't get me wrong, there are hundreds, maybe even thousands of other small credit reporting agencies out there, but D&B, Equifax, and Experian are the main 3 used to qualify you for credit and financing, so those will be the 3 that we're going to focus on. And each of these 3 have 5 main scores that they use. Now, these scores are basically broken down into 2 simple categories. One is based on performance scores. So these performance scores are just basically looking at how you've performed in the past. How have you paid your bills in the past? Then we have predictive scores that are basically used to predict the likelihood that you may default on future obligations. So when we combine these 2, we have 5 total scores that give lenders and credit issuers basically an idea of how you've performed, how you've paid your bills in the past, and the likelihood that you'll continue to pay your bills on time. Now, let's dive in a little bit deeper. So if we look at the top performance scores, these are the main scores used to qualify you for credit and financing, and that's fantastic news for you. So these scores are basically looking at all of the payment data that's reported to the bureaus from vendors that report payment data to them. So for example, if Staples reports your payment data to Dun & Bradstreet, well, Dun & Bradstreet uses the Staples data and everybody else's that's reporting to them to basically look at how you've performed on those obligations. If you're paying them on time, for example, at Dun & Bradstreet, you'd have an 80 score. If on average you pay your bills early, well, you may have an 85, 90, 95, or even 100 score based on how early you pay. But if you're paying late, well, then you may have a 70, 60, 50, all the way down to even a 20 score, depending on average how late you're paying those bills. So the nice thing is all you have to do with these scores is just get enough credit reporting to the reporting agencies and pay those bills on time or early. If you do that one thing, you're going to have good performance-based scores. Now, when we look at the second side of the equation, we look at predictive scores. And predictive scores also take into account all of the trade data that's reported by the vendors that report to those reporting agencies. So by paying your bills on time or early, that also helps your predictive scores as well. But predictive scores also take into account other data and information. So for example, they also look at your public record data. They're going to look at any judgments you have, tax liens, bankruptcies, even lawsuits, and that calculates into the overall scores. They're also going to be looking at things like your company's data. How long has your business been operational? Do you know your NAICS or your business industry code? Are you in a high-risk industry? All these factors calculate into that score as well. And so do other things, including the financial health of your business. that they'll use based on either you submitting financials to the bureaus or them not having financials and looking at the number of employees that your business has. Utilization, all these type of things calculate in to these other 4 scores that the business bureaus offer. Now, the good thing to know is all of these are mainly driven based on payment history. So once again, if you want to improve your scores, get a lot of accounts that report to the reporting agencies, pay them on time or early, it's the best way to get good scores. Other things you could do is avoid public records at all costs. And if you have any public records that are inaccurate or need to be cleaned up, well then dispute those with LexisNexis first, then go back and dispute those with the bureaus. One other thing you want to focus on is if you have good financials like tax returns that show a profit, get those to the business credit reporting agency. Those go a long way to helping your other scores be good as well. If you find that you don't have reports or need to improve those reports, well then check out the link in the description of this training. And I'm going to provide you access to my guide that's been downloaded over 1 million times. Yeah, over 1 million downloads of this guide that maps out the exact steps for you to be able to build business credit. This is going to help you get more accounts that report to the reporting agencies. And again, if you're paying those as accounts as agreed, that's the key to having strong business credit scores. They're going to make you more lendable and also more credible to everyone around you, including customers, clients, insurance companies, utility companies, and anybody and everybody else that's accessing your business credit reports. Did you get value from this training? If so, make sure you like and subscribe and keep your eye out for our next training where we talk about more cool ways to get the money you need to start and grow your business.